For more on Bank of America earnings, let's bring in Mike Mayo from Wells Fargo. Just increased estimates for Bank of America to street high. BAC was also his top pick going into earnings. He joins us on the Newsline. It was the right call because we're seeing the biggest reaction, Mike, up more than 6%. And that is really the thing here, right? There's sensitivity on interest rates going higher. That's what's working, right?
Yes, but that's not the complete story. Look, it's showtime for Bank of America, and Act One looks great. It takes higher interest rates to show the strength of their deposit relationships. It's a lot more sticky than a lot of people thought, and that helps the traditional banking revenues. But it also takes more business to show the scalability of the model, the benefit of a decade of tech investments. Over the last 3 months, Bank of America added almost $2 billion in revenues and $0 in expenses. That is scalability. And it also takes a weaker economy to show the strength of the bank loan portfolios. And Bank of America's credit, their loan portfolios, still looks great. I don't think it's too early to talk about a re-rating, not talking about Bank of America's stock going from a little more than half of the PE of the stock market as a whole back to where it's been, like 2/3 or 3/4. But even above that, once you get past this recession, I think Bank of America will re-rate higher, possibly. Even if they don't do that, we still see the stock about doubling over the next 1 to 2 years.
But the problem, Mike, is what the market is concerned about, and that is recession and a turn in the credit cycle. And even if we're not seeing it now, even Moynihan acknowledged that they're gearing up for a change, and that's why the stock has underperformed. Isn't that a risk?
Absolutely. I mean, if we have a hard landing, then, all bets are off, and you have potential 1/3 downside in the stock. If you don't, you can have a double over, 1 to 2 years. So, reward to risk ratio looks pretty good at 3 to 4 times. So that is a risk. We're not seeing it in the bank results right now. And by the way, we already have credit losses and credit costs, doubling over the next few quarters. So it's not like it's not in our models. And even with that, we're about 15% above consensus for 2023. So Bank of America, it really is a microcosm for the benefit of what bank regulators forced on banks for the last 10 to 15 years, de-risk, more resilient business model, and what Bank of America specifically has done, investing technology, having these digital interactions, and getting that scalability. That is what's really underappreciated here. So it's like a ship going through a storm. Yes, there's a storm out there. It could get worse. But what I found remarkable in your interview is that, he's not positive. The CEO of Bank of America is not positive for the next 4 quarters. He said he expects negative GDP growth.
Yeah.
Negative growth. Even while he expects negative growth, he's giving guidance that implies, much higher earnings. And so that is the difference. That's why it's night and day versus before the global financial crisis. And one of the problems here is that there's so many investment professionals that have only seen one recession, the global financial crisis. Well, every recession is not a global financial crisis, and every recession is not a credit crisis for banks. And so I think what you'll see here is banks will outperform through the recession because a lot of the greatest risk has been pushed outside of the U.S. banking industry. That's not to say you won't have blowups, and there is a risk for banks to have a ricochet effect from blowups outside the banking industry. It is to say, though, they've de-risked to an extent that's likely to lead to better than expected results.